Welcome. Today, we're diving into the world of liquidity ratios, a crucial set of financial metrics that help us understand a company's ability to meet its short term obligations. Whether you're a business owner, investor, or just curious about finance, mastering liquidity ratios can give you a clearer picture of financial health. Throughout this video, we'll break down the key types of liquidity ratios, explain how they're calculated, and discuss why they matter. By the end, you'll have the confidence to analyze these ratios and make more informed decisions. Let's get started by understanding what liquidity really means in a business context. Liquidity refers to how easily a company can convert its assets into cash to pay off its short-term debts. In other words, it's about having enough cash or assets that can quickly become cash when bills are due. Companies with high liquidity are better positioned to handle unexpected expenses or downturns. On the flip side, low liquidity can signal trouble, making it hard to pay suppliers or employees on time. Understanding liquidity is the first step in assessing a company's financial stability. Next, let's explore the main ratios used to measure liquidity. Liquidity ratios are essential for anyone evaluating a company's short-term financial health. They help investors, creditors, and managers determine if a business can cover its immediate obligations. These ratios are often used by banks before approving loans, by investors before buying shares, and by managers to ensure smooth operations. A strong liquidity position can boost confidence among stakeholders, while weak liquidity may raise red flags. Now, let's look at the most common liquidity ratios you'll encounter. Current ratio is one of the most widely used liquidity ratios. It measures a company's ability to pay off its short-term liabilities with its short-term assets. The formula is simple: divide current assets by current liabilities. A ratio above 1 means the company has more assets than liabilities due within a year, which is generally a good sign. However, an extremely high current ratio might indicate that assets aren't being used efficiently. Let's see how this ratio is calculated in practice. Imagine a company with $200,000 in current assets and $100,000 in current liabilities. Its current ratio would be 2, meaning it has twice as many assets as liabilities due within a year. This suggests the company is in a strong position to meet its short-term obligations. However, it's important to compare this ratio to industry averages, as what's considered healthy can vary by sector. Next, let's move on to another key liquidity ratio, the quick ratio. Quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity. It excludes inventory from current assets, focusing only on the most liquid assets like cash, marketable securities, and receivables. The formula is current assets inventory / current liabilities. This ratio tells you whether a company can meet its short-term obligations without relying on selling inventory, which might not be as easily converted to cash. Let's break down how this works. Suppose a company has $200,000 in current assets, $50,000 in inventory, and $100,000 in current liabilities. The quick ratio would be 200,000 50,000 / 100,000 equals 1.5. This means the company has $1.50 in highly liquid assets for every $1 of short-term debt. A quick ratio above 1 is generally considered healthy, but as always, it's important to compare with industry standards. Next, let's look at the cash ratio, the most conservative liquidity measure. Cash ratio is the strictest liquidity ratio. It only considers cash and cash equivalents, ignoring receivables and inventory. The formula is cash plus cash equivalents / current liabilities. This ratio shows whether a company could pay off all its short-term debts immediately using only its most liquid resources. While a ratio of 1 or higher is very safe, most companies operate with a lower cash ratio, balancing liquidity with the need to invest cash elsewhere. Say a company has $40,000 in cash and cash equivalents and $100,000 in current liabilities. Its cash ratio would be 0.4. This means it can cover 40% of its short-term debts with cash on hand. While that might seem low, it's common for companies to keep some funds invested in operations or growth rather than holding large cash reserves. The key is to balance liquidity with profitability. Now let's compare all three ratios side by side. Each liquidity ratio offers a different perspective. The current ratio gives a broad view including all current assets. The quick ratio narrows the focus to the most liquid assets, while the cash ratio looks only at cash and equivalents. By comparing these ratios, you can get a fuller picture of a company's short-term financial strength. It's important to use them together rather than relying on just one to make well-rounded assessment. Next, let's discuss how to interpret these ratios in real-world scenarios. Interpreting liquidity ratios isn't just about the numbers. You need to consider the industry, the company's business model, and economic conditions. For example, a retailer might have a lower quick ratio due to high inventory, but that's normal for the sector. Meanwhile, a tech company might have a higher ratio because it holds more cash. Always compare ratios to industry benchmarks and look for trends over time. Let's see how these ratios are used in financial analysis. Financial analysts use liquidity ratios to assess risk and make recommendations. For example, if a company's ratios are declining, it could signal trouble ahead, prompting further investigation. Conversely, improving ratios might indicate better management or stronger sales. These ratios are also used in credit analysis, helping lenders decide whether to extend credit or loans. Let's look at some real-world scenarios where liquidity ratios play a key role. Consider a retail company with a high current ratio but a low quick ratio. This often happens because retailers hold a lot of inventory, which inflates current assets but isn't as liquid. In this case, the quick ratio provides a more realistic view of liquidity. Analysts would dig deeper to see if inventory is selling quickly or piling up. This example shows why it's important to look beyond the surface and use multiple ratios for a complete picture. Now let's look at a tech company. These businesses often have high quick and cash ratios because they hold less inventory and more cash or receivables. This strong liquidity position can be a competitive advantage, allowing them to invest quickly in new opportunities or weather downturns. However, holding too much cash can also mean missed investment opportunities. It's all about finding the right balance for the business model. Manufacturing companies often have significant inventory and receivables. Their current ratios might look healthy, but quick and cash ratios can reveal tighter liquidity. If receivables are slow to turn into cash, the company could face cash flow issues. That's why it's important to analyze all three ratios and monitor how quickly assets are converted to cash. This approach helps identify potential risks before they become problems. Creditors pay close attention to liquidity ratios when deciding whether to lend money. A company with strong liquidity is less likely to default on its obligations, making it a safer bet for lenders. On the other hand, weak liquidity ratios can lead to higher borrowing costs or even loan denials. That's why maintaining healthy liquidity ratios is critical for businesses that rely on external financing. Let's see how managers use these ratios internally. Managers use liquidity ratios to monitor day-to-day financial health and make strategic decisions. For example, if ratios are slipping, they might delay new investments, speed up collections, or negotiate better payment terms with suppliers. By keeping a close eye on liquidity, managers can avoid cash crunches and keep operations running smoothly. Next, let's discuss how liquidity ratios relate to company growth. Growth often requires investment, which can strain liquidity. Companies expanding rapidly may see their liquidity ratios dip as they invest in inventory, equipment, or new markets. While some decline is normal, it's important to ensure ratios don't fall too low, risking financial stability. Balancing growth with liquidity is a key challenge for businesses. Let's look at how seasonal businesses manage liquidity ratios. Seasonal businesses, like retailers or tourism companies, often experience fluctuations in liquidity ratios throughout the year. They may build up inventory before peak seasons, temporarily lowering their quick and cash ratios. After the busy period, ratios typically recover as sales convert inventory to cash. Understanding these cycles helps managers plan ahead and avoid liquidity shortfalls during slow periods. Investors use liquidity ratios to assess risk before buying shares. A company with strong liquidity is less likely to face financial distress, making it a safer investment. However, extremely high liquidity might suggest the company isn't using its resources efficiently. Investors look for a balance, enough liquidity to handle surprises, but not so much that growth opportunities are missed. Let's explore the limitations of liquidity ratio. While liquidity ratios are valuable, they have limitations. For example, they're based on balance sheet figures, which are just a snapshot in time. They don't show how quickly assets can actually be converted to cash or whether receivables are collectible. Also, ratios can be manipulated by timing payments or collections. That's why it's important to use liquidity ratios alongside other financial metrics in qualitative analysis. Liquidity ratios focus on short-term financial health, while solvency ratios look at long-term stability. Solvency ratios measure a company's ability to meet all its obligations, not just those due soon. Both types of ratios are important, but they answer different questions. Liquidity tells you if a company can pay its bills this year. Solvency tells you if it can survive for the long haul. Let's clarify the key differences. Liquidity ratios are all about the short term. Can the company pay its bills in the next year? Solvency ratios, like the debt-to-equity ratio, focus on the long term. Can the company meet all its financial commitments over time? Both are vital for a complete financial analysis. By understanding the distinction, you can better evaluate a company's overall financial health and risk profile. Industry benchmarks are essential when analyzing liquidity ratios. What's considered healthy in one industry might be risky in another. For example, supermarkets often operate with lower liquidity ratios due to fast inventory turnover, while construction firms may need higher ratios because of longer project cycles. Always compare a company's ratios to relevant industry averages for meaningful insights. Looking at trends over time is just as important as the ratios themselves. A company with stable or improving liquidity ratios is generally in good shape. Declining ratios could signal emerging problems like slowing sales or rising expenses. By tracking liquidity ratios quarter by quarter or year by year, you can spot issues early and take corrective action before they become serious. Liquidity ratios and cash flow statements go hand in hand. While ratios show a snapshot, cash flow statements reveal how money moves in and out of the business over time. A company might have a strong current ratio but weak cash flow if receivables aren't collected promptly. That's why it's important to analyze both liquidity ratios and cash flow for a complete financial picture. If a company's liquidity ratios are too low, there are several strategies to improve them. These include speeding up collections, reducing inventory, delaying payments to suppliers, or raising additional capital. Each approach has pros and cons, and the best solution depends on the company's unique situation. Let's look at some practical tips for managing liquidity. Effective liquidity management involves regular monitoring, forecasting cash needs, and maintaining good relationships with banks and suppliers. Companies should set internal targets for liquidity ratios and review them frequently. Using technology to automate collections and payments can also help. By staying proactive, businesses can avoid surprises and ensure they always have enough cash to operate smoothly. Liquidity ratios play a key role in financial planning. They help managers anticipate cash needs, plan investments, and prepare for emergencies. By incorporating liquidity analysis into budgeting and forecasting, companies can make smarter decisions and reduce the risk of cash shortages. Let's see how liquidity ratios fit into the broader financial strategy. During economic downturns or crises, liquidity ratios become even more important. Companies with strong liquidity can weather tough times, pay their bills, and avoid bankruptcy. Those with weak liquidity may struggle to survive. That's why many businesses build up cash reserves or secure lines of credit as a safety net. Let's discuss how liquidity ratios are used in mergers and acquisitions. Mergers and acquisitions, liquidity ratios are closely scrutinized. Buyers want to ensure the target company can meet its obligations and won't drain resources after the deal. Sellers may try to improve their ratios before negotiations to boost valuation. Understanding liquidity ratios helps both sides make informed decisions and structure deals that protect their interests. Regulators often set minimum liquidity requirements for banks and financial institutions to ensure stability. These rules help prevent crises by making sure institutions can meet withdrawal demands and other obligations. Companies in regulated industries must pay close attention to liquidity ratios to stay compliant and avoid penalties. Working capital is closely related to liquidity ratios. It's the difference between current assets and current liabilities. Positive working capital means a company can cover its short-term debts, while negative working capital signals potential trouble. Liquidity ratios provide a more detailed view by showing the relationship between assets and liabilities, helping managers fine-tune their working capital strategies. There's often a trade-off between liquidity and profitability. Holding too much cash can reduce returns, while investing aggressively can strain liquidity. The best companies find a balance, maintaining enough liquidity to stay safe while investing surplus funds for growth. Regularly reviewing liquidity ratios helps ensure this balance is maintained. Business cycles affect liquidity ratios. During booms, companies may invest more and see ratios decline. In downturns, they may conserve cash, boosting liquidity. Understanding how these cycles impact ratios helps managers make better decisions and prepare for changing conditions. Liquidity ratios are a key part of risk management. By monitoring these ratios, companies can identify potential problems early and take action to reduce risk. This might include tightening credit policies, renegotiating supplier terms, or raising capital. Proactive risk management helps ensure long-term success. Liquidity ratios are often highlighted in annual reports and financial statements. Investors and analysts look for trends and compare ratios to previous years and industry peers. Transparent reporting of liquidity ratios builds trust and helps stakeholders make informed decisions. For small businesses, liquidity ratios are especially important. Smaller firms often have less access to credit and need to manage cash carefully. Regularly tracking liquidity ratios helps small business owners avoid cash flow problems and keep their operations running smoothly. Startups face unique liquidity challenges. They may have limited revenue and rely on investor funding. Monitoring liquidity ratios helps startups manage their runway and plan for future funding rounds. It's crucial for founders to understand these ratios and use them in financial planning. Nonprofit organizations also use liquidity ratios to ensure they can meet their obligations and continue serving their missions. Donors and grantmakers often review these ratios before providing funding. Maintaining healthy liquidity is essential for long-term sustainability in the nonprofit sector. Global businesses face additional liquidity challenges such as currency fluctuations and cross-border transactions. Monitoring liquidity ratios in each market helps multinational companies manage risk and allocate resources effectively. It's important to adapt liquidity management strategies to local conditions. Technology is transforming liquidity management. Advanced analytics, real-time dashboards, and automation tools make it easier to track and improve liquidity ratios. Companies that leverage technology can respond faster to changes and make better financial decisions. A common mistake is relying solely on liquidity ratios without considering the bigger picture. For example, a high current ratio might look good, but if it's due to slow-moving inventory, it could signal problems. Always analyze the components of each ratio and use them alongside other financial metrics for a comprehensive view. Let's recap what we've learned. Liquidity ratios are vital tools for assessing a company's short-term financial health. The current, quick, and cash ratios each provide unique insights. Always compare ratios to industry benchmarks, analyze trends over time, and use them alongside other financial data. By mastering liquidity ratios, you'll be better equipped to make informed financial decisions. Congratulations on reaching the end of our deep dive into liquidity ratios. Understanding these ratios is a key step toward financial literacy and smarter business decisions. Keep practicing your analysis, stay curious, and continue exploring other financial metrics to build a well-rounded understanding of business finance. Thanks for watching and see you in the next video.